Hey guys, it's Crypto. She does it a little bit of everything. I am going to explain what is a recession and why having a lot of job is not good for the recession. Okay, it is my job to report to you guys things that I have heard so often in the past few months, days, and yes, you might know what's a recession, but because Americans are going to work like nobody's business, it actually not helping the recession to go down. So let's go. What is a recession? A recession is a significant, widespread, and prolonged downturn in economic activity. A common rule of thumb is that two consecutive quarters of negative gross domestic products (GDP) growth mean recession. Although more complex formulas are also used. Economists at National Bureau of Economic Research (NBER) measure recessions by looking at non-farm payrolls, industrial productions, and retail sales, among other indicators going far beyond the simpler, although not as accurate, 2 quarters of negative GDP measured. I heard Janet Yellen was saying we cannot be in a recession if the job market is so low. So there was a fight, a confusion of the two consecutive negative, let's see what it says here. 2 consecutive quarters of negative GDP measure. There was a big fight about that. If there was so many jobs, so many Americans are working, spending, why are we in a recession? That's the fight. I don't understand it. I'm just going to report to you what I have read and you try to figure it out. However, the NBER also says there is no fixed rule about what measure contribute information to the process or how they are weighted in our decision. A recession is a significant, pervasive, and persistent decline in economic activity. Economists measure a recession length from the prior expansion's peak to the downturn through. Recessions may last as little as a few months, but the economy may not recover to its former peak for years. An inverted yield curve has predicted the last 10 recessions, although some predicted recession never materialized. An inverted yield curve has predicted the last 10 recession, although some predicted recession never materialized. Unemployment often remains high well into an economic recovery, so the early stages of rebound can feel like a continuing recession for many. Nations use fiscal and monetary policies to limit the risk of a recession. Okay. A downturn must be deep, pervasive, and lasting to qualify as a recession by the NBER's definitions. But these calls come after the fact. It is not a clear formula to identify a recession as soon as one begins. Important. In June 2020, the NBER said the U.S. economy's expansion peaked in February 2020, falling into a recession caused by the COVID-19 pandemic. The next month, the economic expansion that started in June 2009 lasted 128 months, surpassing the 120-month expansion from 1991 to 2001 as the longest stretch of uninterrupted growth in the U.S. history. In July 2021, the NBER concluded that the 2020 recession was the shortest on record at just 2 months, with economic activities hitting bottom in April 2020. Understanding recessions. Since the Industrial Revolution, most economies have grown steadily and economic contractions are an exception, although recessions are still common. Between 1960 and 2007, there were 122 recessions that affected 21 advanced economies roughly 10% of the time, according to the International Monetary Fund, IMF. In recent years, recessions have become less frequent and don't last as long. The decline in economic output and employment that recessions cause can become self-perpetuating. For example, declining consumer demand can prompt companies to lay off staff, which affects consumer spending power, which can further weaken consumer demand. Similarly, bear market that often accompany recession can reverse the wealth effect, suddenly making people less wealthy and further trimming consumption. Since the Great Depression, governments around the world have adopted fiscal and monetary policies to prevent a run-of-the-mill recession from becoming far worse. Some of these stabilizing factors are automatic, such as unemployment insurance that puts money into the pockets of the employees who lost their job. Other measure requires specific actions, such as cutting interest rates to stimulate investment. Economic expansion by duration. Economic expansion begins at the through of a business cycle at lowest point and end at its peak, after which the economy begins to contract, kicking off an economic recession. Okay, they have all kind of dates and stuff here. Let me see what it says. Okay, from June 2009 to February 2020, from March 1991 to March 2001, from February 1961 to December 1969, from November 1982 to July 1990, from November 2001 to December 2007, from March 1975 to January 1980, from October 1949 to 1953, from May 1954 to August 1957, from October 1949 to July 1953, from May 1954 to August 1957, from October 1945 to November 1948, from November 1970 to November 1973, from April 1958 to April 1960, from July 1980 to July 1981. Those are the years and the month of the recession lasted. Recessions are usually clearly identified only after they are over. Recessions are usually clearly identified only after they are over. Investors, economists, and employees may also have very different experience in terms of when a recession is at its worst. Equities markets often decline before an economic downturn, so investors may assume a recession has begun as investment losses accumulate and corporate earnings decline, even if other measures of recession remain healthy, such as consumer spending and unemployment. Conversely, since unemployment often remains high long after the economy hits bottom, workers may perceive a recession as continuing for months or even years after economic activity recovers. What predicts a recession? While there is no single surefire predictor of recession, an inverted yield curve has come before each of the 10 U.S. recessions since 1955, although not every period of inverted yield curve was followed by recession. When the yield curve is normal, short-term yields are lower than long-term yields. This is because longer-term debt has more duration risk. For example, a 10-year bond usually yields more than 2-year bond, as the investor is taking a risk that future inflation or higher interest rate could lower the bond value before it can be redeemed. So in this case, the yield goes up over time, creating an upward yield curve. The yield curves inverts if yields on longer dated bonds go down while yields on shorter term bonds goes up. The rise of near-term interest rates can tip the economy into a recession. The reason why the yield on long-term bonds drops below that on short-term bonds is because traders anticipate near-term economic weakness, leading to eventual interest rate cuts. Eventual interest rate cuts. Investors also look at a variety of leading indicators to predict recession. These include the SM Purchasing Manager Index, the Conference Board Leading Economics Index, and the OECD Composite Leading Indicator. What caused recession? Numerous economic theories attempt to explain why and how the economy goes into recession. These theories can be broadly categorized as economic, financial, psychological, or a combination of these factors. Some economists focus on economic changes, including structural shifts and industrials, as most important. For example, a sharp, sustained surge in oil price can raise costs across the economy, leading to recession. Some theories say financial factors cause recession. These theories focus on credit growth and the accumulation of financial risk during good economic times, the contraction of credits and money supply when recession starts, or both. Monetarism, which says recession are caused by insufficient growth and money supplies, is a good example of this type of theory. Okay, this is what is recession. And when I get back from picking my son up, I'm gonna give you the reason or the good job report is hurting the Fed. It's not in their advantage, because they want to bring the recession down, but since everybody's working and spending money, it's not good for them. Again, don't forget to subscribe. Crypto Marie, she does it all, a little bit of everything. Bye.